Hello everyone, welcome again to Hybrid Accounts, and we are here to proceed with the last part of ICE 12 income taxes, right? Income what? Income taxes. So let's finish up with the last portion and be done with the standard. So business combinations and the deferred tax. Okay, so you're going to look at various things which may happen upon doing business combinations. On business combinations, we usually attempt to get the goodwill, right? And how do we get the goodwill? We take the purchase consideration. Let's say someone has purchased 80% of the company. So you take the purchase consideration or called investment cost. We add the non-controlling interest. This is the worth of equity that is owned by other members, that 20%. Then you get 100%, and then you less the net asset, fair value of net what? Assets. After lessing fair value of net assets, then you are going to get the goodwill, right? This is fair value of what? Fair value of net assets, right? Yes. After getting the favor of net assets, now we would have the goodwill, right? Now we are going to look at everything that happens here and affects and has something to do with the deferred tax. We said that initial recognition of goodwill doesn't. Inapanda. Inapanda. Huyu. Huyu. Ndio zangu zangu. Watu. Bora. Ana. Anapanda. All right, so you can see here they're starting with fair value adjustments. It seems it's fair value adjustment of on net assets. They start to deal with this point here, right? Okay, so the identifiable. So we already the standard already said that initial recognition of goodwill has nothing to do with what? With deferred tax, right? So we'll let it be. So we are done with the goodwill. We remain with all the remaining ones. So the identifiable assets and liabilities of the acquired subsidiary are consolidated at fair value. That's done at fair value. And I think I've shown it here, fair value. But the tax base derives from the values in the subsidiaries individual financial statements. This is the main point you have to get from this now, right? So once the identifiable assets and liabilities are taken at fair value, right? The tax base is derived from the values in the subsidiaries individual financial statement. So there are likely to be differences here, right? That's why we say a temporary difference is created, and so deferred tax must be recognized in the consolidated financial statement. So first of all, I think you know why you do record, you do account for deferred tax. Because the tax base are different, the reference for taking figures for deferred tax here is different from that for the carrying amount, right? Okay, so the deferred tax recognized is treated as part of the net asset of the subsidiary. Of course, when we get this net asset here, if we have the deferred tax, we usually apply it right away. You're going to see that no problem, right? At the acquisition date, and as a result, it affects the amount of goodwill recognized. That's why we do not affect initial goodwill directly, but the goodwill will ultimately be impacted because the goodwill is just a result of what happened, right? I hope you got that. Okay. So, all right, now let's look at the example here. Down here is called the Tom, right? It says on 30 June 2021, here, Tom acquired 100% of the shares of Jones for $300,000. And this is the purchase consideration, right? And 100%, so there was no non-controlling interest. At this stage, the carrying amount of the net assets of Jones was 250,000, and included in this net asset figure is inventory, which cost 50,000, but which had a replacement cost of 55. You see, so inventory has a different value or fair value, right? The applicable tax rate is 30%. So what I would have to do, explain the deferred tax implications of the above in the consolidated financial statements of the firm group, right? Okay, so that's just easy. It's test understanding number 9. Let's just call and accomplish this. So according to IFRS 3 business combination, we usually compute goodwill, taking it as the purchase consideration, which is 300,000 plus non-controlling interest. For our case, it is nil. So we just said NCI here, non-controlling interest, but for our case, it's what? It's nil, so I just put nil there. And then we deduct the fair value of the net assets. Fair value of net assets. Now, to get the fair value of net asset, of course, there are several ways of getting fair value of net asset, right? You can just take the equity in the statement of financial position, and equity means assets minus liabilities. And so you make adjustment for assets and what? And liabilities, right? For our case here, we are told that the net assets were 250. So you have the net assets here, the carrying amount of net assets, and then you adjust. If assets are increasing, you increase it. Assets are decreasing, you decrease it. If you have liabilities, and if liabilities increase, they would lower the net assets. If liabilities decrease, they would increase the net what? Net assets. So first of all, we start with something specifically stated. Inventory was having a value of 50, but its replacement of 55. So inventory has to be uplifted by 5,000. That's why you see fair value uplift on inventory. This one is on what? Inventory by 5,000. And if inventory is increased by 5,000, it means net assets would also increase by the same figure, right? You see it here. So what you do now, for the deferred tax asset and liability, you have to include that deferred tax liability. Because remember, you have an asset now. As for inventory, we have the carrying amount at how much? The carrying amount was at 50,000, right? 55 now. Since we have not changed it to 55, we had the carrying amount of 50, what? 50 how much? 55. And what about the tax base? We are told that for the tax base, we go and deal with the individual financial statements. In the individual financial statements, the figure was only 50,000, right? So the tax base would be only 50. You see, so you'd get the difference here. 55 minus 50 gives you 5. And 5 is the temporary difference, which is taxable because it is an asset, right? Carrying amount of an asset exceeds the tax base, and then you have an asset, right? You have a taxable temporary difference. Since this is taxable, you multiply it by the tax rate of 30%, like you see here, and you get 1,500, which is a deferred tax liability, right? So you would credit a deferred tax liability, and then you debit the net assets. So that's why here we are debiting the net assets. Net assets have a credit nature. So by debiting net assets, it means you are reducing the net assets here this way, right? So you get this figure here, and then you deduct and get the goodwill at the acquisition at this figure. So goodwill at the acquisition may well be affected by the deferred tax effects of what? On goodwill, right? Yeah, that's all. And then I think we can proceed more. Okay, here we are. Let's go on provisions for unrealized profit. Okay, now what is provision for unrealized profit? I initially explained this a bit, but a very little. But simply speaking, provision for unrealized profit come this way, right? When you have a parent and then you have a subsidiary. Now, when you prepare consolidated financial statement, you prepare them as a single entity. As a single what? As one entity. Now, presume that parent, let's say, parent has sold goods to subsidiary, but subsidiary has not sold all its goods out. So when you combine the results, they become one. So it's like the group has sold goods to its, and then the impact will be that it would have the revenues and the cost of sales and the profits in its own books, right? So what we do, we eliminate the revenues, the costs, but also the profits which are yet to be realized, right? Okay, so that's what we call provision for unrealized what? Profit. So whatever profit that relates to the goods or as any other assets which are still with the entity has to be removed, right? Yes. So for example, provision for unrealized profit could be on inventory, could be on or even on maybe non-current assets, maybe the assets, the vehicle has been sold by a parent to the subsidiary. So it really depends, right? Okay, now see here, you say when one company with a group sells inventory to another, that's what we're speaking about, right? So what matters here, what we look of here to get the double entry, if you're not doing consolidation here, so you just need to get the little concept, right? We look that someone will have an asset. If the parent sells to the subsidiary, it means that the subsidiary will have an asset, right? And the parent will have the profit. This is what matters. So one party has the profit and one party would have the asset. That's what we mean. So our main attempt here is to remove them, remove the profit from the parent, but also remove the asset, remove this figure from the asset of a what? Of a subsidiary. It could have gone reverse way, right? So the first thing is to remove the asset. The asset is of a debit nature. So to remove the asset, it will be to credit. That's why you see credit inventory, right? And then for the profit, now how do we remove the profit? The profit is the result of the income statement. And the income statement, it has expenses and revenues, right? And since now we are going to say that we reduce, right? It's either we reduce the revenue or we increase the cost of sales, right? Inventory is part of cost of sales, right? Cost of sales equals to opening inventory plus purchases minus closing what? Inventory. And so we choose the line item of cost of sales is to know the place to adjust for the provision for unrealized profit. So you go on and debit the cost of sales, kind of increasing the cost of sales now, which will be have an impact of reducing the profit, right? So that's why you see debit cost of what? Cost of sales. So that's why we have these figures and also these figures, right? It won't matter, even if the subsidiary is sold, you do the same thing. You're not dealing with consolidation, so we won't go further into the impact, right? Yes. So just need to know this thing. So that's all. Yeah. So what are you told here? Let's look at the impact on the deferred tax now. That was just consolidation. You see, the adjustment reduces the inventory, reduces the asset, but also reduces the what? The profit in the consolidated financial statement. But the tax base, see here, the tax base of the inventory remains as it costs, just like we said before. We usually take the tax base the same way. So you can see the carrying amount of inventory has been reduced by the provision for unrealized profit, but the tax base has been the same. You see the issue there? All right, so by that, we would have a deductible temporary what? Difference because presume that the inventory had the worth of 100, right? This was the original, which you take it as a tax base. But maybe for accounting base, the accounting base, or you can just say the carrying amount now, we take 100 now in the consolidated books, and maybe you minus provision for unrealized profit. Let's say it was 10. That was the provision for unrealized profit. So 100 minus 10, you have 90 here, right? So if you take the difference, you find that 90 minus 100 equals to negative what? Negative 10. This negative 10 is the provision for unrealized profit, and you will always see that it's negative, right? Getting 90 minus 100 equals to negative 10. Negative means that it would bring the deferred tax asset, right? So just multiply by the tax rate to get the deferred tax asset figure. All right. Not that you may find it easier to think of an adjustment. No need to that. in terms of profits. That's why I explained that in terms of profits, so you don't need to worry about that. Let's look at this question here. We are told MAG has owned 80% of ordinary shares of glass for many years. And then you're told here that during the current year, MAG sold inventory to glass. So MAG is the parent, but the parent has sold goods to the subsidiary for $250,000, making a gross profit margin of 40%. 1/4 of this inventory remains unsold by glass at the reporting date, and the tax rate is 20%. What to do now? Discuss the deferred tax implications of the above transaction. Okay. What are we going to do? First of all, we need to compute the provision for unrealized profit. First of all, let's look. For the tax base, we take the figure as it is, right? Inventory had what value? 250, so you can have our 250 there. We say that's the tax base. Okay, how do we get the carrying amount? How do we get the carrying amount now? Getting the carrying amount would be this way, right? This was the inventory sold for this. MAG sold inventory for this figure. So this is the selling price, but we have a gross profit margin of 40. So what is the profit, total profit? Profit, you can take the gross profit margin times the selling price, right? So 40% times 250 would get 100,000. I'll just write 100 here. And now we need the provision for unrealized profit. Unrealized profit is the percentage of profit that still remains with the books. The amount of profit embedded in inventory that is yet to be sold, right? We are told 1/4 of this inventory remains unsold by glass at the reporting date. So now, to get provision for unrealized profit, the PURP, we call it PURP, should take 1/4 times 100. 1/4 times 100, how much would it be now? It would be 1/4 times 100, which would expectedly give us 25, right? Yes, so I would have 25. So 25 should be my unrealized profit. You see now? Okay, you can take it directly, but actually maybe let's try to be more practical and see how we would do it in the normal way. Up is 25 now. Now remember, the carrying amount, how much would the carrying amount be in your case? We said that to get the carrying amount, you have to take 250. Remember in the books we had 250. For consolidation, we usually take the carrying amount and then we adjust. If we have fair value adjustment, we adjust. If we have provision for realized profits, we adjust. So here we would take 250 minus 25, which would remain with 225, right? 220 what? 25. You see there, you'd have 255. And let me put it as positive. The tax rate is what we deduct, right? For assets. So you say that, okay, I'll be having this one tax base. So 225 minus 250, you get negative 25. Negative 25 means this is the deferred tax asset, right? Deferred tax asset, it indicates the deferred tax asset. So you just need to multiply. Take 20% times this difference, 20% times 20% times 25, which is 5, right? So whatever you get here should be the deferred tax asset, and they could just make the entries as appropriate, right? You can see here, down here, 20% times that one will get 5. This is 5,000. It is a deferred tax asset. Previously, you had nothing, but now you have 5,000. So deferred tax asset is on the debit side this way. The corresponding side will just be the tax what? Expense. Right. I hope you have seen that. And then we can go on. Let's proceed. Let's proceed. I think this should be the last one. So you have a lot of applications. This one is not, you shouldn't say that, okay, oh, deferred tax has a lot of things. No, it's not a lot of things. This one is good because you are just kind of consolidating your knowledge, right? Unremitted earnings. What about this unremitted earnings? How do you deal with this? We also say that a temporary difference may arise when the carrying amount of investments in subsidiaries, let's say you have invested in a subsidiary, let's say it's an associate, if a joint venture is different from the tax what? The tax base. Yes. The investment values now, right? We are speaking of the investment. That's why I told you that goodwill is obtained by purchase consideration plus non-controlling interest minus the what? net assets, fair value of net assets. Now you're speaking of the investment cost. The carrying amount in consolidated financial statements is the investor's share of net assets of the investee, right? Plus the purchased goodwill. If maybe you have the purchased goodwill, then that one will be fine, right? You can say that, okay, I have these as the net assets. I invested 80%. So you take your 80% and then you add the goodwill. This is how you get the carrying what? The carrying amount, right? Okay. The tax base now is usually the cost of the investment because it's usually for the tax base to go to the normal cost of an asset, right? So you can see now how we deal with that investment cost. The difference is the unremitted earnings. The difference between these two is what we call unremitted what? Unremitted earnings. So you say that, okay, I invested 80% maybe by paying $1,000. I have it here. This one will be the cost of the investment. But to get the carrying amount in the consolidated financial statements now, you would go on and take the share of the net assets, which is share of equity. It will be given, of course, in percentage, plus purchased goodwill, and then you get the difference, right? Which you call unremitted earnings or undistributed profit of the subsidiary associated. Okay, down here, we go down, down, down. We are told, IAS 12 said that deferred tax should be recognized on the temporary difference, which is normal, except when, so we do recognize deferred tax except when the investor controls the timing of the reversal of the temporary difference, right? If the investor had that control, then that one will be the problem. And also, it is probable that the profits will not be distributed in the foreseeable future. This one makes sense too. If the profits won't be distributed, how can you say that you are going to claim that in the future? You won't say that, right? So the probable profit will not be distributed. You have to leave it around, right? Or in case the investor controls the timing of the reversal, the investor can decide. If he controls, they can even decide maybe to take it maybe a lot of years later, right? And you know, the farther into the future, the more the uncertainty, right? So, lastly, an investor can control the dividend policy of a subsidiary. We are speaking of this control now. How should you know that the investor has control or not? Right. An investor can control the dividend policy of a subsidiary, but not always that of other types of investment, right? This means that the deferred tax does not arise on investments in subsidiaries, but may arise on investments in associates and joint what? And joint ventures because of this principle here, right? And that's why if you look even in that question above, on the question that we did, we looked on the fair value adjustment on inventories and we got the deferred tax liability. We didn't focus on that initial investment. We just used it to compute goodwill, but we didn't focus much on it, right? Due to this one, because an investor can control the dividend policy of a subsidiary because it has control, but not always of other types of investment. For example, for associates, we just have significant influence. For joint ventures, it's not like one investor can decide. They have to combine to make a joint decision, right? That's why we avoid subsidiaries, but if you have associates or joint ventures, we can do it. So financial assets may give rise to deferred tax assets if they are remeasured to fair what? To fair value. Of course, it's just like PPE or maybe investment property. When you do that, right, you find out that there has been a change in fair value. So if there is a change in fair value and the difference is temporary, tax authorities will not recognize it immediately, but in the future they will. Of course, it should also be a deferred. It should also arise to deferred tax, right? Okay. All right, we have the disclosures here. You should always disclose this. An entity must disclose the major components of its tax expense, right? The tax recognized directly in equity, like we saw on share-based payment, right? There is tax which recognized directly in what? In equity. Tax relating to items recognized directly in equity, the tax relating to each component of other comprehensive income. So this one should be disclosed. You should know the tax relating to each component of other comprehensive income and an explanation of the relationship between tax expense and the accounting profit. Okay, let's look at this example here, test your understanding. I think, okay, let's look at this last example here and be done. with the standard. Okay, test your understanding 11 HCRM. It says in the year ended 31st December 2021, HCRM recorded a profit before tax of 300 million, while its tax rate is 20%. Okay. In accordance with the 12 taxes, income taxes, it has disclosed the following information in its published financial statements. Okay, you have the profit before tax at 300. Profit before tax, you multiply by the tax rate, which is, it was 20%. Total 20% times 300, you have 60 there. Adjustment to current tax in respect of prior years. Okay, you know, we call this over or under provision of taxes, right? Over or under provision of what? Of taxes. Let's say they've just said this one, 8.2. They haven't mentioned whether it's an over or under provision, right? Okay. Okay, if it's an under provision, it should increase this tax rate, right? If it's an over provision, it should not increase. This seems to have increased, so this one is an under provision, right? Yes. So simply speaking, we have this one. Okay. Depreciation on assets not qualifying for tax relief. Okay, maybe there are some assets which do not qualify for tax relief, and the depreciation was involved. So you have this depreciation here. Standard disallowable, we have this one here, and you have the total tax charge, which is here, right? And lastly, you have what? Effective tax rate. What do we mean by effective tax rate? We mean this way, right? Initially, it seemed like we applied 20%, but in reality, at the end, you find out that the total tax charge is 70.4. So I think they have taken 70.4 over 300, right? 70.4 over what? Over 300. I think this is what has been done over 300. 70.4 over 3, you know, it should be like 23 point something, right? 0.5 something. So this is the percentage obtained. 70.4 divided by 300, and this is what they have. Okay, discuss why this disclosure provides useful information to HCRM, the investors. Why? The investors get a picture that, okay, tax rate is 20%, but including all these adjustments, it's like 23.5, point what? 0.5, right? Okay, so that's all. You can just see it here. We say users of financial statements need information to help them assess an entity's future profits and future cash flows. So they need to know the actual thing that is going on profits, which can easily be manipulated, but also on future cash flows, right? Kind of value-based measurement. The tax rate reconciliation is important for understanding the tax charge reported in the financial statements. Like you have seen there, it has moved from 20 to 23.5. So the main reason for the difference between the statutory tax, which is 20 given, and the effective. Effective is what has actually affected, has actually impacted us, right? It is due to current tax adjustment. We have adjusted for the current tax there. And HCRM under accrued in a prior period for current tax, we see that we have an under provision. If you see this one, it's just the adjustments to current tax in respect of prior periods. Since it have added the tax, it means it was an under provision. Maybe we initially, you know, for the current tax, we usually estimate. Maybe we estimated this 70, or maybe we estimated you're going to pay 20, but we ended up paying 28.2, right? So since we underestimated, we said that, okay, we underestimated, so this year I have to include that 8.2 extra. That's why you have it here, right? And of course, it has been the main cause. You know, the remaining figures 1.5 and 0.7 are just minor. That's why you say the main reason is due to the current tax what adjustment, the under provision. HCRM under accrued in prior periods for current tax, resulting in additional expense in the current period. And so investors need to assess whether the effective tax rate is likely to be static or volatile, and so must analyze comparative information to understand whether HCRM has a history of under accruing or over accruing for current tax, right? So you should say, okay, so this is what happened. The problem for the current tax, the problem which occurred last year, it is incorporated this year. For this year, incorporated next year, and so on and so on. So to get the picture of how this happens, The investors or the potential stakeholders, they should compare the results for several years to check on the reality, right? So this will inform profit and cash flow forecast to get a proper view, right? So that's the important thing you needed to know here. And so one-off and unusual items, the items which occur just once, right, can have a significant effect on the effective tax rate. Yes, there could be something happening maybe which could raise taxes a lot or could lower taxes a lot, but just once. Depreciation on assets that do not qualify for tax relief, for example. You have depreciation on assets that do not have tax relief, is likely to be a recurring item year on year. But other reconciling items should be explained so that investors can assess if they are likely to want to recur. So simply speaking, this question was just trying to give you a picture of how the effective tax rate could differ from the statutory one due to the tax adjustments, right? Yeah, so that's all. Uh, our topic is done. I wish you proper revision, nice revisions, and let's meet up next time. Thank you.